So, if you look back at 2025, over 830 million people worldwide actually paid for a premium music subscription.
Yeah, which is just a staggering number when you think about it.
Right. I mean, they're handing over 10, 12, maybe $15 a month every single month, basically just to soundtrack their lives.
Exactly. It's a massive recurring revenue engine.
And sitting right at the absolute center of that colossal flow of capital is Universal Music Group.
Yeah.
I mean, they pulled in, what, 12.5 billion euros in revenue?
Yeah, 12.5 billion. It's wild.
It is. On paper, it just looks like this unstoppable cultural and financial juggernaut. I mean, they own the rights to arguably the most universally loved product on earth.
They do. And this is the fascinating part. If you read the buy-side investment memo we're unpacking today, the conclusion is actually incredibly jarring.
Yeah, because this memo from May 2026 basically argues that despite all that scale, despite the revenue and the undeniable cultural dominance buying UMG stock today, is just a demonstrably terrible idea.
It is a phenomenal paradox, really. And I think it forces you to confront, one of the most difficult cognitive biases in investing, which is the halo effect.
The halo effect of a beloved consumer product.
Exactly. You look at UMG, which, by the way, trades under the ticker UMG in Amsterdam and UMGNF over the counter in the US, and you don't see a corporation. You see the Beatles. You see Taylor Swift.
Right, you see the soundtrack to your wedding or your high school graduation.
Yeah. And it is incredibly difficult to separate the emotional resonance of all that intellectual property from the cold, mechanical reality of the corporate entity that just happens to hold the rights to it.
Which is exactly our mandate for this deep dive today. We are going to strip away the glamour of the music industry and essentially perform a forensic autopsy on the underlying machinery of this business.
Right. We're looking at this strictly through the lens of an institutional investor, so evaluating capital allocation, structural leverage, and, long-term margin trajectory.
So looking at their core economic model outlined early in this memo, I have to say, the whole romanticized image of the music industry is it's totally absent here.
Oh, completely. The A&R reps in smoky underground clubs discovering the next generational talent. That is not what this business is at scale.
No, from an operational standpoint, this isn't really a creative enterprise at all. It's a massive, scaled, rights and distribution toll booth.
Toll booth is the perfect word for it. They've positioned themselves squarely in the middle of a massive traffic flow.
Right, because on one side you have the artist creating the raw material, and on the other side you have Spotify, Apple, YouTube, and ultimately you, the listener.
And UMG just sits right in the middle, lowers the gate, and collects a fraction of a cent every single time data moves from point A to point B.
It's fascinating. And the sheer physics of that toll booth are wild when you break them down.
I mean,
The model doesn't rely on predicting the future, right? It relies on monetizing the past.
exactly. The absolute bedrock of the business is catalog depth. UMG owns or administers millions of copyrights.
So when a classic rock anthem from the 1970s gets played today,
UMG incurs virtually zero new marketing costs, zero production costs, zero distribution costs.
the digital file just sits on a server somewhere.
Right, and the cash flow is entirely passive and highly, highly accretive to their margins.
And then you have to layer on their publishing division, which I think people get confused by.
Yeah, people often conflate recorded music with publishing, but they are very distinct, massive revenue streams.
So the recorded music side owns the specific audio recording, right? The
Yeah.
master.
Yes, but the publishing side owns the underlying architecture of the song, so the lyrics and the melody.
So every time a UMG-owned composition is, say, covered by a new artist or licensed for a massive global ad campaign or put in a blockbuster film,
The publishing arm collects its toll regardless of who actually sang that specific version. It's incredibly lucrative.
I've always kind of thought about investing in record labels as being akin to investing in a massive venture capital fund. Well, like, you spread your capital across thousands of unproven startups, in this case, young artists knowing full well that 99% of them are going to be absolute commercial failures.
Right, but you fund them anyway because you're hunting for that one unicorn.
Exactly. That one global megastar whose massive stadium tours and billions of streams pay for all the misses.
It makes sense intuitively, but when you look at these cash flow statements, the venture capital analogy actually feels totally inadequate.
Yeah, the memo makes it clear it's much closer to owning a critical piece of infrastructure. like the George Washington Bridge.
Right. You aren't betting on the destination of the cars. You're just betting that the volume of traffic crossing the river will continue to rise.
And that you have the pricing power to hike the toll without anyone finding a detour.
Exactly. But, and this is a massive caveat in the memo, the structural flaw in that infrastructure assumption is the competitive landscape.
Because UMG isn't a monopoly.
No, it's not a pure monopoly. It is a powerful oligopoly. If you want to cross the river, you don't actually have to take the UMG bridge.
Right. Warner Music Group and Sony have built their own massive parallel bridges.
Exactly. Now, UMG's bridge is undeniably the widest, and it has the most lanes, which gives them unparalleled global marketing reach.
Which matters a lot for artists, right? Like if a domestic superstar in Brazil wants to launch a coordinated campaign across Southeast Asia and Western Europe simultaneously.
UMG has the boots on the ground. They have the localized radio relationships and the regional platform leverage to execute that globally in a way an independent label just simply cannot.
Right.
But they cannot charge an infinite toll. If they push the streaming platforms too hard on royalty rates, or if they offer unfavorable terms to a rising superstar.
Those entities can and will seek alternative routes.
Exactly.
So to understand how they even built a toll booth with this much structural leverage in the first place, I want to look back at the architectural history of the company.
Yeah, because you don't just wake up one morning with a 12.5 billion euro revenue run rate.
Right. And the defining era really begins in 2011 when Lucian Grange took over as CEO. And, I mean, you have to contextualize just how apocalyptic the music industry felt in 2011.
Oh, it was bleak. Physical CD sales had completely collapsed.
And the digital download era, led by iTunes, had provided a temporary tourniquet, but it definitely wasn't a sustainable growth engine.
Plus, piracy was still rampant. Spotify had just barely launched in the United States.
And the vast majority of traditional music executives still viewed streaming as a cannibalistic threat, not a savior. Like, the prevailing sentiment was that recorded music was a structurally declining asset class.
Which it is exactly what makes Grange's defining move in 2012 so strategically audacious. While his peers were hoarding cash and just trying to manage the decline, he went on the offensive.
The EMI acquisition.
Yes, he orchestrated the massive acquisition of EMI's recorded music division. And at the time, EMI was one of the legendary Big Four labels.
Right, holding the rights to artists ranging from the Beatles to Katy Perry.
So by absorbing EMI, UMG didn't just marginally increase its market share. It fundamentally transformed the center of gravity in the global music industry.
Because it massively expanded their high-margin catalog depth.
Exactly. Which immediately gave them unmatched leverage in every future negotiation with a digital distributor.
And the scale of that newly combined entity was so terrifying to competitors that it actually triggered intense antitrust scrutiny on both sides of the Atlantic.
Yeah. They were forced to divest certain assets just to get the deal approved. That's how big it was.
And what's crazy is that for a long time after that acquisition, UMG was virtually impossible for a retail investor to access directly.
Because it was buried deep within Vivendi, the French media conglomerate.
Right, is the classic hidden asset scenario. If you wanted exposure to this massive music compounding machine, you had to buy Vivendi.
Which meant you were also unwillingly buying into European pay TV networks, legacy advertising agencies, telecommunications infrastructure.
It's a mess of unrelated assets.
Right. The true underlying value of UMG was entirely obscured by the conglomerate discount. The market just had no pure mechanism to price the asset.
But then that opacity began to shatter in 2020. Management executed what the memo calls a master stroke of external validation.
Yes, selling a 20% minority stake to a consortium led by Tencent, the Chinese tech giant.
And they didn't just sell it. They sold it at an implied enterprise valuation of 30 billion euros.
Which was a watershed moment.
Yep.
It sent a massive, undeniable signal to the global capital markets.
It was Vivendi definitively stating, hey, highly sophisticated strategic Asian private capital has looked under the hood of this hidden subsidiary and determined it is worth 30 billion on a standalone basis.
Exactly. That transaction completely re-anchored the market's expectations and basically set the runway for the ultimate uncoupling.
The September 2021 spinoff.
Right. Vivendi finally cuts the cord, distributes the shares to its own investors, and lists UMG on the Euronext Amsterdam.
And it opens trading at an indicative reference price around 18 euros and 50 cents. So suddenly, the toll booth is public.
Yeah.
Institutional money can flow directly into the pure play asset.
But, and this is crucial, that transition from a shielded subsidiary to a standalone public entity fundamentally changes the incentive structures.
Because you're no longer insulated by a massive parent company.
Right. Every single move you make, every contract negotiation, every strategic standoff is hyper-analyzed by activist hedge funds and institutional analysts who are demanding quarterly growth.
Which brings us perfectly to the first major public stress test of their leverage, the TikTok standoff in early 2024.
Oh, man. This was a brutal, very public game of chicken.
Yeah. So in January of that year, UMG allowed their licensing agreement with TikTok to expire without a renewal.
And they didn't just issue a sternly worded press release, they hit the kill switch. They pulled their entire catalog off the platform.
I remember that. Millions of user-generated videos suddenly went totally silent overnight.
Yeah, and UMG's public stance was that TikTok was severely underpaying their artists relative to the massive advertising revenue the platform was generating.
But more critically, and I think this is super relevant now, UMG drew a hard line in the sand regarding generative AI.
Yes, they accused TikTok of allowing the platform to be flooded with AI-generated audio that essentially diluted the royalty pool and infringed on human artists' intellectual property.
The blackout lasted for months. And what was fascinating was watching the power dynamic play out in real time.
Because on one hand, UMG was flexing incredible muscle. They were proving to the market that they were willing to endure severe short-term pain.
Right, sacrificing months of promotional visibility and licensing revenue.
Just to protect the long-term structural economics of their intellectual property.
But then, in May of 2024, they folded, or at least they compromised. They announced a new licensing agreement and brought the catalog back.
They claimed they secured better commercial terms and robust AI protections. But the memo argues the duration of the blackout revealed a profound vulnerability.
The vulnerability of mutual dependence.
Exactly. The reality is that UMG could not afford a permanent divorce from TikTok.
Because in the modern ecosystem, short-form video platforms are the primary discovery engine for new music, especially for younger demographics.
Right? If your artist's new single isn't trending on TikTok, it effectively doesn't exist in the cultural zeitgeist.
It won't cross over to Spotify playlists, and it won't drive concert ticket sales.
So UMG management stared into the abyss of losing an entire generation of top-of-funnel discovery, and they blinked. They secured a deal, but the standoff permanently shattered the illusion that UMG holds unilateral dictatorial power over digital distributors.
And the TikTok fight wasn't even their only public brawl. This memo heavily scrutinizes the 2026 listing drama as well.
Oh, the Pershing Square dispute, that was messy.
Really messy. Management had been aggressively signaling to the market that they were planning to shift their primary stock listing from Amsterdam to the United States.
And the strategic logic there was obvious, right? U.S. capital markets generally award significantly higher valuation multiples to media and tech companies than European markets do.
But then, in March of 2026, they abruptly shelved the plan. They cited macroeconomic volatility and market uncertainty.
Which immediately triggered a massive public feud with Pershing Square.
Right. Bill Ackman, who controls a massive block of UMG shares, went on the offensive. And activist hedge funds are not exactly known for their patience.
No, they are not. And Pershing's subsequent unsolicited proposals and all the resulting corporate infighting were incredibly distracting.
Which forces a very complex evaluation of management's overall scorecard.
Because if you isolate their operational strategy over the last decade, the rating is undeniably strong.
Grange and his team were not dragged kicking and screaming into the streaming era. They actively catalyzed it.
Exactly. They licensed their catalogs aggressively, optimized their release strategies for algorithmic discovery, and perfectly rode the macroeconomic wave of global smartphone penetration.
But when you evaluate their corporate governance, their capital allocation, and their stakeholder communication, the memo rates them as fair to weak.
Because the public spat with Pershing Square was highly reactive, deeply distracting, and it really highlighted a profound disconnect between the executive suite and the largest outside shareholders.
You know, I'm reading this operational history, and I'm trying to square this with the bearish thesis of the memo.
How do you mean?
Because a bullish investor would look at this exact same timeline and say, look, they survived the death of physical media. They brilliantly orchestrated the EMI consolidation. They navigated the transition to streaming. They successfully stared down TikTok to protect their AI rights.
They've already fought and won the hardest existential battles.
Exactly. The moat is built. Why should an investor pay a premium for a fortress that has already survived the siege?
It's a fair question, but in financial markets, you do not get paid for the battles you have already won. You only get paid for the future cash flows you can generate. And the memo's central thesis is that the victories you just listed actually represent the harvesting of a massive one-time demographic dividend.
A one-time dividend.
Yeah.
Like transitioning 1 billion people from stealing music on BitTorrent to paying $10 a month on Spotify.
Exactly. That was a miraculous hyper-growth tailwind, but that harvest is over. The low-hanging fruit has been entirely consumed.
So the future battles are exponentially more difficult.
Vastly harder. Trying to figure out superfan monetization, for example, convincing the top tier of listeners to pay $50 a month for exclusive digital access, is way harder than convincing a casual listener to pay $10.
So the easy growth is in the rearview mirror, which means the current premium valuation is completely unanchored from the future growth reality.
Precisely.
And that transition from easy growth to structural friction leads perfectly into how we evaluate their current operational footprint, because there's a massive tension between their global scale and their platform dependency.
Let's look at the sheer size of the operation first, just to ground it.
Right. 12.5 billion euros in revenue for 2025. You mentioned Warner Music earlier. They sit at roughly $6.7 billion.
So UMG is nearly twice the size of its closest pure-play competitor.
And what's really interesting is that they haven't destroyed their balance sheet to maintain that size. Entering 2026, their net debt was sitting at 2.39 billion euros.
Right. And when you measure that against their 2025 adjusted EBITDA of 2.81 billion, you are looking at a leverage ratio comfortably below 1 turn.
For a legacy media business with highly predictable recurring catalog cash flows, that is a remarkably conservative, fortress-like balance sheet.
They are definitely not suffocating under interest payments, that's for sure.
But the composition of that revenue requires some serious deconstruction, according to the memo.
Right. Roughly 75% of that 12.5 billion comes from the recorded music division. This is the high-risk, high-reward engine room.
This involves the massive upfront capital expenditures required to sign new talent, fund the studio time, and execute the global marketing rollouts.
And the remaining 25% is a mix of the highly stable publishing division, which, as we discussed, is the underlying composition rights, and their merchandising and direct-to-consumer operations.
And management aggressively markets this multi-pronged approach as an impenetrable moat.
They argue that because they control the master recording, the publishing rights, and the T-shirt sales, they have effectively locked down the entire economic ecosystem of an artist.
But the memo challenges the very definition of that moat. When we talk about moats in modern investing, we usually mean enterprise software, right? We mean switching costs.
Yes, like if a Fortune 500 company integrates their entire global logistics network into Oracle or SAP, the sheer financial and operational agony required to rip out that software and switch to a competitor is astronomically high.
So Oracle has them trapped. They can raise prices almost with impunity.
But UMG's suppliers are human beings. They are artists.
And when a superstar's multi-album contract expires, the switching costs are effectively zero.
None. They can walk across the street to Warner, they can negotiate a joint venture with Sony, or, increasingly, they can retain their own masters and use an independent distribution service.
Right, so to prevent that massive talent flight, UMG has to deploy its capital defensively. UMG retains artists by writing incredibly massive upfront cash advance checks.
And agreeing to vastly inferior royalty split ratios on future streams.
So the moat exists, but it's not a structural switching cost moat. It's a checkbook moat.
A checkbook moat. And maintaining a checkbook moat continuously erodes your own operating margins. The balance of power over the last decade has decisively shifted away from the major labels and toward the superstar creator.
Which brings up one of the most counterintuitive concentration metrics I have ever seen in a financial disclosure.
You're talking about the top 50 artists stat?
Yes. UMG management loves to highlight the fact that their top 50 artists account for only 22% of their recorded music revenue.
Which sounds great at first glance.
It really does. When I first read that, I was stunned. In most media businesses, the Pareto principle is absolute. The top 1% of talent generates 90% of the revenue.
Right.
So the fact that their top 50 global megastars only make up 22% of the pie suggests an incredibly healthy, diversified, long-tail supply base. It looks like they are immune to the risk of one or two divas deciding to retire or jump ship.
It is a brilliant piece of corporate communication. They are actively highlighting the extreme diversification of their suppliers.
But the memo brutally pivots the lens to look at the distributors.
Yes. The supply of music is highly fragmented, but the distribution of that music is perilously concentrated.
In their 2025 filings, UMG disclosed that just 3 customers accounted for a staggering 42% of their total global revenue.
42%. Three companies controlling almost half the revenue of the biggest music label on Earth.
And while UMG carefully avoids naming them directly in that specific risk factor disclosure, the market knows precisely who they are, right?
Of course, it's Spotify, Apple, and Alphabet through YouTube.
This is the concentration paradox. Millions of artists, tens of millions of songs, all being squeezed through just three massive digital bottlenecks.
And if you are assessing risk, you have to ask yourself, who actually holds the leverage in a closed room when UMG sits across the table from Spotify?
UMG is huge, but Apple and Alphabet are sovereign digital nations.
Exactly. If Spotify tweaks its algorithmic discovery engine to subtly favor independent artists who have agreed to lower royalty payouts, UMG's market share can bleed out incrementally without them being able to do a single thing about it.
They are a massive toll booth built on a highway owned by someone else.
That's exactly the risk.
Wow. Okay, so that standoff with TikTok, the sheer cost of keeping artists happy during a blackout, and the looming threat of the Spotify algorithm. It all bleeds directly into the most alarming part of this memo.
The financials and the margins.
Yes, we need to look at where all this revenue is actually going, because if you look purely at the top-line growth, you'd think the machine was running perfectly.
They added hundreds of millions of euros in new revenue in 2025.
But when you look at the profitability of that new revenue, the entire growth narrative fractures. The memo points out that their adjusted EBITDA margin, the actual percentage of revenue they keep as operating profit after direct costs, stayed completely flat at 22.5%.
It didn't budge.
Not a single basis point.
And in the context of a scaled digital business, a flat margin is a massive red flag.
Why is that so alarming for a digital business?
Because the entire premise of investing in a digital rights company is operating leverage. The theory is that once you have paid for your global headquarters, your executive suite, and your IT infrastructure, your fixed costs are essentially capped.
So every incremental euro of revenue that comes in from a new Spotify subscriber should drop almost directly to the bottom line.
Exactly. If you are a true compounding machine, your margins should be expanding relentlessly as you scale.
But the fact that UMG grew its revenue massively, but its margin flatlined at 22.5%,
It proves that the operating leverage is fundamentally broken.
I'm looking at the direct costs, and it is obvious where the money is leaking out. It's leaking straight into the pockets of the artists.
Yeah, the memo highlights that direct artist costs spiked to 46.7% of total revenue in 2025.
Which proves exactly what we were just discussing about the checkbook moat. To maintain their market share, they're being forced to hand over an increasingly massive slice of the pie to the creators.
In fact, UMG's own cash flow statements reveal a 216 million euro negative hit to their operating cash flow in 2025, driven entirely by the timing of major artist renewals and extensions.
They are burning hundreds of millions in upfront cash just to keep the talent in the building.
The economic benefits of their massive scale are literally being competed away by inflation in the talent acquisition market.
And the margin compression is only half the problem, right? The other half is the illusion of top-line growth.
Right, because if you glance casually at their Q1 2026 earnings release, UMG reported very solid growth in subscription revenue.
But the memo performs a critical forensic teardown of that growth. First off, a massive chunk of that revenue increase was inorganic. It was purchased.
Right, UMG had recently acquired a company called Downtown, which artificially inflated the year-over-year comparables.
And second, much of the remaining organic growth was driven purely by pricing leverage. Platforms like Spotify and Apple Music unilaterally raised their monthly subscription fees from $10.99 to $11.99.
And a percentage of that price hike flowed through to UMG.
But relying on price hikes is a notoriously fragile growth strategy. It is the definition of squeezing a finite sponge.
You can raise prices once or twice, but eventually you hit consumer elasticity and the cancellation rates spike.
So if you strip away the Downtown acquisition and you strip away the artificial boost from the price hikes, what is the actual underlying volume growth of people streaming UMG's music?
The math is brutal. Excluding the acquisition, UMG's constant currency streaming growth in Q1 2026 was a microscopic 1.2%.
Wow, so the actual volume of consumption has effectively flatlined.
It has. And this shatters the central myth of the streaming era, the total addressable market illusion.
The TAM.
Right. For years, sell-side analysts modeled UMG's future by pointing to the billions of smartphones on the planet and assuming streaming penetration would just grow endlessly.
But the TAM is not infinite. The developed markets, North America, Western Europe, Japan, They're entirely saturated.
Everyone who has the disposable income and the desire for a premium streaming account already has one.
The only subscriber growth left is in emerging markets, where the average revenue per user, the ARPU, is a tiny fraction of Western markets.
Exactly. Adding 1 million subscribers in India does not move the revenue needle the same way adding 1 million subscribers in the US did a decade ago.
And it is not just that the volume of streaming is stagnating. The actual nature of consumer attention is radically shifting.
Yeah, the memo tracks a profound migration in consumption habits throughout 2025 and early 2026.
The hours that a teenager used to spend passively listening to a highly monetized UMG playlist on Apple Music are actively being replaced by hours spent scrolling lower monetization, short-form video platforms.
They are leaving Spotify to watch YouTube Shorts, Instagram Reels, and TikTok.
And the monetization disparity there is critical, isn't it?
It's huge. If a user listens to a 3-minute UMG track on Spotify, UMG collects a specific, predictable, high-margin royalty.
But if that same user spends 3 minutes scrolling TikTok, they might hear 6 different 15-second clips of UMG songs buried beneath a creator's voiceover.
Right. UMG still gets paid, but the economics of short-form video licensing are vastly inferior and much harder to track accurately.
So the consumer attention is migrating away from the core high-yield product toward a peripheral low-yield format.
Exactly. So you have a business grappling with completely flat operating margins, skyrocketing talent costs, stagnant volume growth, and a consumer base actively shifting to less profitable mediums.
That is a toxic cocktail for a company priced for perfection.
It really is.
Which makes the next section of the memo absolutely explosive.
Yeah.
We need to talk about capital allocation and governance, because the decisions management is making with the cash food, they do generate border on financial malpractice.
Let's start with the most important metric in any mature business: free cash flow.
Right, because revenue can be manipulated, accounting profits can be adjusted, but free cash flow is the actual unencumbered cash left in the bank after the business has paid its operating expenses and made the capital investments necessary to survive.
It is the only money that truly belongs to the shareholders.
And in 2025, UMG generated 702 million euros in free cash flow.
702 million. Keep that exact number in mind because the subsequent capital distribution is where the math completely detaches from reality.
Yeah.
Despite generating only 702 million in actual cash, UMG distributed 954 million in dividends to its shareholders.
They paid out almost €250 million more than they actually generated. How is a supposedly sophisticated management team justifying a dividend payout that exceeds their cash flow?
They hide behind a stated corporate policy of paying out a fixed percentage of their accounting net profit rather than anchoring the dividend to actual free cash flow.
But it gets dramatically worse. Not only did they fund a massive uncovered dividend, but they simultaneously launched a €500 million share buyback program.
They are shoveling cash out the door at a rate that vastly exceeds the generative capacity of the underlying business.
It is like someone taking out a high-interest home equity loan to fund a lavish month-long vacation and then liquidating their retirement account to buy stock in their own stagnant, struggling small business.
That's a great analogy.
How are they physically funding this deficit?
Yeah.
Because they aren't generating the cash. Are they just levering up the balance sheet?
No, they are funding it by cannibalizing their own asset base. In April of 2026, UMG announced that in order to fund these aggressive buybacks, they were going to sell half of their equity stake in Spotify.
Let's analyze the logic of that Spotify sale, because it makes zero sense unless you were desperate.
Yeah.
Spotify is the dominant distribution platform.
Yeah.
It is a fast-growing technology company that effectively dictates the future of global music consumption. And UMG is selling a highly strategic, appreciating asset just to buy back its own stagnant, margin-compressed stock.
From an institutional perspective, selling a fast-growing asset to buy your own stock only makes financial sense if you believe your own stock is wildly, irrationally undervalued by the market.
But is UMG undervalued? Let's look at the valuation.
It is the exact opposite of undervalued. In mid-2026, UMG's equity value was hovering around 38 billion euros.
And the stock was trading at roughly 13 times its adjusted EBITDA.
But the far more punishing metric is the free cash flow yield. If you take that 702 million in cash and divide it by the 38 billion market capitalization, you get a free cash flow yield of less than 2%.
Less than 2%. An investor could buy a risk-free short-term U.S. Treasury bill or European government bond and instantly guarantee a return, double or triple that yield.
Without taking on any of the massive structural risks of the music industry?
Right. You are being asked to take on all the risk of shifting consumer habits, AI disruption, and talent inflation. And your reward is a sub 2% cash yield.
Which is why the aggressive buyback program looks less like a strategic mechanism to return value to outside shareholders and more like a desperate attempt to prop up the stock price.
And the memo goes further, directly tying this capital allocation disaster to executive compensation. The governance red flags here are massive.
Yeah, let's talk about 2025. CEO Lucian Grange's total compensation package was 41.1 million euros.
41.1 million for a single executive in a single year. Let's contextualize that against the free cash flow.
Right, the 702 million.
The entire global operation, thousands of employees, millions of artists, generated 702 million in cash. And the CEO personally extracted roughly 6% of that total cash flow just for himself.
That level of value extraction is staggering.
And the compensation structure is insulated from accountability. The memo meticulously notes that Grange's severance terms explicitly violate and exceed the established best practice guidelines set forth by the Dutch Corporate Governance Code.
The executive suite has effectively built a financial fortress around themselves.
Furthermore, a significant portion of that 500 million euro share buyback program isn't actually retiring shares to increase the ownership percentage of outside investors.
No, it is simply being used to satisfy the massive equity obligations the company owes to its own executives under these exorbitant compensation plans.
They are using shareholder cash to buy stock just to hand it directly to management.
And when you have that level of internal value extraction, you inevitably find layers of accounting obfuscation to justify it.
The memo dedicates a significant section to what it diplomatically calls accounting complexity.
Right now, they aren't accusing UNG of fraud. The cash in the bank is the cash in the bank.
But the gap between the story the company tells and the reality of the financials is massive. In 2025, UMG proudly reported an adjusted net profit of 1.9 billion euros.
But if you dig into the actual SEC equivalent filings, the reported net profit strictly attributable to shareholders was only 1.5 billion euros.
That is a 400 million euro discrepancy.
And when you drill down into the footnotes to see where that 400 million went, you find a labyrinth of adjustments.
You find massive add-backs for non-cash share-based compensation, which, as we just discussed, is a very real expense that dilutes shareholders.
You find aggressive catalog amortization schedules. You find massive, unpredictable swings based on the mark-to-market accounting of their equity stakes in other public companies.
The forensic conclusion of the memo is stark. Investors might be willing to tolerate heavily adjusted, messy accounting in a distressed turnaround stock that is trading at a massive discount.
But UMG is demanding to be priced as a flawless, premium compounding machine.
And you cannot demand a premium valuation while utilizing deeply compromised, highly complex accounting metrics. The trust deficit demands a massive discount.
Absolutely.
So we have spent the last hour systematically dismantling the bullish narrative. We have looked at the toll booth mechanics, the history of the EMI acquisition, the TikTok mutual dependence, the flatlining margins,
the exorbitant artist costs, the shifting consumer attention, the negative cash flow dividend,
the Spotify asset sale, and the 41 million euro CEO payout. If an investor is sitting at their desk looking at the UMG ticker and trying to synthesize this entire diagnostic X-ray, what are the absolute core takeaways?
The memo crystallizes into 4 undeniable realities that the market is currently refusing to price in.
Okay, let's hear them.
First, the distinction between a phenomenal asset and a rational investment. UMG is an irreplaceable cultural institution. It owns the soundtrack of modern human history. It is a great company.
But buying a great company at a price that demands absolute perfection from an imperfect business model is the fastest way to destroy capital. The 38 billion valuation is completely disconnected from the 702 million cash reality.
Exactly. Second, the gravity of their margins. The market assumption that UMG's massive scale will inevitably lead to expanding profitability has been proven mathematically false.
Because the economic benefits of their scale are being systematically competed away by the inflation of superstar talent costs and the fragmentation of consumer attention into lower-margin video formats.
Right. Their 22.5% margin is a rigid ceiling, not a baseline for future expansion.
And the third reality is the profound governance discount. The executive compensation structure is deeply misaligned with the long-term outside shareholder.
When a management team is extracting $41 million a year while simultaneously selling off strategic assets like the Spotify stake to fund buybacks at a sub 2% yield, the trust deficit is insurmountable.
You are partnering with a management team that is prioritizing short-term equity stabilization and personal compensation over long-term capital preservation.
And finally, the fourth reality, the structural growth challenge. The golden era of the streaming transition is definitively over.
The low-hanging fruit of moving global populations from piracy to a $10 monthly subscription has been harvested.
So UMG's future growth now relies entirely on highly fragile mechanisms, pushing platforms to constantly hike prices and trying to invent unproven superfan monetization models.
Those are high-friction, low-probability growth engines that cannot mathematically support the current market multiple. The buy-side conclusion is absolute. The underlying business is formidable, but the stock at these prices is utterly uninvestable.
Well, the devastatingly clear analysis.
It really is. But before we wrap up, I want to leave you, the listener, with one final existential thought to mull over. We touched very briefly on generative AI during the TikTok standoff, framing it primarily as a copyright infringement issue.
Right.
But look further down the horizon. What happens when AI doesn't just mimic existing artists, but democratizes the creation of high-fidelity music to the point where supply truly becomes infinite?
That's the real threat.
In a future where 10 million new, hyper-personalized, algorithmically generated tracks are uploaded to Spotify every single day, the value of the legacy catalog might fundamentally shift.
If the sheer volume of noise becomes deafening, the true bottleneck of the industry will no longer be who owns the old music.
The ultimate power and the ultimate profit will shift entirely to the platforms, the digital algorithms that curate the noise, control the discovery, and dictate exactly what gets pushed into your headphones next.
If the algorithm becomes more valuable than the catalog, the entire UMG toll booth collapses.
That is the generational threat. They survived the transition from physical to digital, but surviving the transition from human scarcity to algorithmic infinity is a battle they are not currently structured to win.
Definitely something for investors to think about.
And that profound shift in the creative economy is a deep dive for another day. Thank you for joining us on this exploration of Universal Music Group. We hope this forensic teardown helped cut through the cultural nostalgia and provided a clearer, colder look at the machinery operating beneath the music. Keep asking the hard questions, keep interrogating the margins, and we will see you on the next deep dive.